Understanding the topic that we're going to talk about today on day 14 of 30 investing terms that you should know will save you hundreds, if not thousands, if not tens or hundreds of thousands of pounds. It will save you a load of money. So lock into this one. Today, we need to have a very serious conversation about volatility. And volatility, in the simplest form, is the degree to which your share price or the share that you're investing in's price moves, whether it be up and causing a gain for you or down and causing a loss. Not all shares that you invest in are going to have the same level of volatility. Some of them are going to be really volatile and they're going to go up loads and down loads as the days go by. And some of them are going to just kind of stay in a small range of moving up or down. Investments that are believed to have high volatility are seen to be high risk investments. The reason being that yes, they can increase rapidly in price, which would cause you to have a large gain in your investment. But at the same time, they can also reduce in value quite sharply and quickly, which would mean that you would realize quite a large loss in your investment. Opposite to high volatility investments, you have low volatility investments, which are lower risk because ultimately that price isn't going to move very much. So you can kind of guarantee that they're a bit of a safer option. Bonds that we covered a few days ago come to mind when we're talking about low risk, low volatility investments. Examples of high volatility investments can be emerging markets and cryptocurrency. Now, where people tend to lose a lot of money when it comes to volatility is they don't understand that even though the price has gone down of something they've invested in, that price deduction is not realized unless you sell the investment or you sell the shares that you hold, right? However, the price of that investment could recover. And if it would recover, you would have made your money back if you hadn't sold your holding. And if you want to get back in now, you're gonna have to pay a higher price. Think of it like this. If I'm an ice cream man and I've got a load of stock of ice cream, I've already bought the ice cream, and then it rains, right? It's been sunny all week and I've been selling the ice cream for £2 an ice cream, and then it rains the next day. All of a sudden, no one wants ice cream. So if I do sell them, I have to sell them for less, maybe 50p per ice cream, because no one wants ice cream when it's raining. But then the next day is sunny again. But if I'd sold all of my ice creams when it was raining for 50p each, I would have realized a loss on my investment. If I'd just waited a day for the weather to recover, I would have made maximum profits from my investment of ice cream. Investing in stocks and shares works in a very similar kind of way. Prices can go up as well as down, but don't be emotional and think because the prices are down, you're going to lose all of your money. Usually that isn't the case. Not always, but usually that isn't the case. Be pragmatic, have a strategy, and make sure that you're utilizing diversification. Congratulations on completing day 14 of 30 investing terms that you should know. I'll see you tomorrow for our next lesson.